Hello, this is Sky Moore. This segment is on accounting. That is generally accepted accounting principles in the United States, GAAP in shorthand. There's a bit of a schizophrenic approach to accounting of what the goals are. On the one hand, they want to accurately report the income and loss of a particular period. And on the other hand, they want to allocate costs within a particular period to other periods that they believe are more accurately attributable to that expense. And this ambiguity in accounting leads to a number of games and a number of potential manipulations of how you report your results. And this is for generally accepted accounting principles. It has nothing to do with tax or participations or with distributions to net equity owners. First game that companies love to do is accelerate income from a future period into the current period. And that's relatively easy to do under the accounting rules. The classic example is if a film company enters into a 10-year license that provides for $1 million a year for 10 years, you would think that they would report the income of $1 million a year for 10 years as they get it. But in fact, under the accounting rules, they're able to report all of that in the first year based on the present value of that income stream. It's treated like a sale of the property effectively for an installment note. For example, if you lease real property for 10 years with $1 million a year, you're not allowed to accelerate the income. For some reason in the film industry, the rules are different and they permit acceleration. Along these lines, what you'll often see is that companies will purport to sell property or license it for cash because they want to report the cash on a cash statement, but then they will loan the other side of the equation the same amount of cash and they'll report that as an investment. So you'll see these loan sale transactions that are really just accounting gimmicks, again as a way to accelerate the recognition of income and the acceleration in this case of cash on the cash statement. The other game that applies in the accounting rules is anytime you have an expense, what you want to do is instead of reporting it as a current expense and deducting it, you want to capitalize it, which means that you add it to the cost of some existing property. And in the film industry, that's usually a film. And that achieves two salutary benefits. Number one is it increases your current reported net income or decreases the loss if you were running at a loss. And the other thing it does is it increases the assets on your balance sheet because now instead of a film that has a cost of $10 million, if you have $1 million expense that you can add to it, it now becomes $11 million. So on your balance sheet, it looks much better. So capitalization is a huge game that goes on. Any questionable expenses, how much of overhead or indirect costs or costs in acquiring a new market or new customers, what do you do with those? And when in doubt, companies tend to want to add that to some existing asset. Next game is deferring write-downs. So let's say you've built up this big film library and it's, maybe it's overvalued, or at least on your balance sheet for accounting purposes it's overvalued. What you want to do is defer the deduction of that as long as possible. And in the film industry, we're able to do that with what's called film income amortization. And the way you deduct your film costs for accounting purposes is that every year you take your film costs and you deduct a portion of it that is based on a fraction. The numerator is current year's income and the denominator is your total expected income. And the net result of all of that is that the more income you can project going out in the future, the smaller will be your deduction in the current year. And so income forecast amortization permits film companies to defer the deduction of film costs by overestimating future income. And you will often see film companies wildly overestimate, for example, what they think that a film will do in the video market or in the TV market and ancillary markets. And the reason that they're doing that is to reduce the amount of amortization that they take up front. And that, again, achieves two benefits. It lowers current deductions, so you increase current net income, and it will keep your balance sheet as high as possible for as long as possible. Another game that comes up in accounting is what's called an extraordinary loss. And what you often find is that companies build up these massive assets on their balance sheet, and sooner or later, new management comes in and says, I don't want to show this as a loss on my watch, so let's treat it as an extraordinary loss. And we will all of a sudden write down the cost of the film library to current market value, and because of some extraordinary event, which, like an earthquake or who knows what. And the key is that that loss will not pass through the income statement. It will not show up as a current loss. It's because it's an extraordinary loss. And all of a sudden you basically get to clean the slate and start over. Finally, another thing to keep an eye out for is consolidation. And the consolidation in the accounting rules work as follows. If you're a parent company and you control a subsidiary, and you have to draw a circle around both, and you consolidate and report the aggregate earnings and balance sheet of both as though it's one company. At the extreme, what Enron was doing was Enron was playing games of trying to deconsolidate bad companies so that even though Enron had control of them indirectly, Enron pretended that it didn't control them to try to get them off the balance sheet. That's deconsolidation. And on the other side, if there's a company that you do like, that you want to consolidate with you, you pretend to control it, even though maybe in fact you don't. And those companies you can consolidate on your balance sheet and your income statement. The net result of all of this is that, in my opinion, it's difficult to trust accounting balance sheets and income statements without really looking at these issues. So you want to always look hard. Has income been accelerated? Has there been a deferral of write-downs? Have items been capitalized that shouldn't be? And is consolidation going on? And if you take those issues into account, then you can get a better sense of whether the balance sheet and income statement are accurate. And again, I want to emphasize that these are totally different rules than tax and contractual and distributions to net equity, which we'll discuss in subsequent sessions. So this is Sky tuning out on this segment. Hope you join me for the next one.